Whenever now a statement of cash flow is to be prepared, we do have two methods which may be used in terms of computing or in terms of presenting our statement of cash flow. Now, the first method is the direct method, and number two, we do have the indirect method. Now, the difference between these two methods of presenting the statement of cash flow is how we compute the net cash flow from operating what activities. Now, under the first method there, that is under the direct method, the cash flow or the net cash flow from operating activities is computed directly from the cash book, meaning that the net cash flow from operating activities is computed directly from the cash book, and therefore under this particular method here, to compute now the net cash flow from or the cash flow from operating activities, we compute this first of all by taking the cash which was received, from debtors, stroke customers. And what you need to note is that if at all we have money which is received from debtors or customers to a business, that entail inflow of cash. Basically, what you have said is that when preparing now the statement of cash flow, if at all we have any activity which entail inflow of cash, or if we have inflow of cash, we have that usually as a positive. As what? As a positive, because that is inflow of cash. But anytime we have outflow of cash or outflow of money out of business, that should be a negative. So therefore, first of all, we take that. We also take into account the cash paid to creditors, stroke suppliers, of which now the cash paid to creditors stroke suppliers, that is a cash outflow. So once we have that, we then proceed and also take into account the cash paid for operating expenses, Still, that cash which is paid for operating expenses is still a cash outflow. So and then we get the net amount. Once now we have the net amount, we proceed and we less the tax paid. And the reason why we paid the tax paid is because whenever the tax is to be paid, if you can be able to remember a topic of income taxes, we say that the tax should be paid from the operating profit. So therefore we less that. So we less tax paid, and the tax paid still, that is a cash outflow. So and then we get the net cash flow. From operating activities. So that how we are supposed now to compute the net cash flow from operating activities under the direct method. Now, under the other method, that is the indirect method, in terms of now how we compute that cash flow from operating activities, we are supposed now to adjust our profit with various items, usually 3 items. You're going to look on those items. So mean that under the indirect method, I've said that we compute the net cash flow from operating activities, from operating activities is computed by adjusting the operating profit. Now the operating profit, in other terms, we refer to that as profit before interest and tax. So we adjust that profit by adjusting the operating profit with 3 items. So one of the items which will be adjusted to that profit is the non-cash items. Remember, we have said that non-cash items, these are those items of income and expenses which were used in terms of computing this particular profit here, but do not entail movement of cash. Good examples we have said include depreciation, include gain stroke loss on disposal, include what we refer as a provision for doubtful debt and so on. 2, we also adjust our operating profit there with the changes in working capital. Now, when talk about working capital generally is the difference between the current asset and current liabilities. But in our case here, when considering the changes in working capital, we consider a change in 3 items. We consider change in the inventories. We consider change in the trade receivables, and also we consider change in trade payables. So those are basically the 3 components of working capital which we consider. 3, we also adjust that particular profit with the financing activities, stroke investing activities items, which were either added or deducted in arriving at that word profit. A good example maybe of this is something like investment income, the investment income. For instance, if when the company was preparing the income statement, the company accounted for investment income as part of the other incomes. What you need to note is that investment income will already be included in the profit which was reported during that year. But an investment income here, this is not an income from what? Operation. It is not an income from operation, and therefore, because it has already been added there, what you are supposed to do when preparing or when computing the cash flow from operating activities, then we should erase it from our profit. Now, I want us to look on basically the format of preparing now the statement of cash flow now under this method. But as you are going to see, the difference between these 2 methods, direct method and indirect method, is only in terms of how we compute the net cash flow from operating activities.